Good morning, everybody. Hope you guys can hear me okay. Gonna get started here in just a second. All right. All right, perfect. Can you guys hear me okay? Just quickly want to make sure before we get started that we're good on that front. And then we'll get going. Awesome. All right. Very good. Cool. Let's get started. Again, good morning, everybody. Serge Berger here from thestudytrader.com. Hope you guys are doing well. We are experiencing the volatility that we've been kind of talking about for quite some time. That is likely going to happen, and is likely going to emanate from those Max 7 stocks, and that's exactly what's happening right now. Unfortunately, I think a lot of people are unwilling to accept that this might be something longer lasting, and I should probably explain what I mean by that, which I will in just a second. My notepad, what's going on here? Number one, I have a very, very important dollar chart I want to show you. It's a new one, not the one we talked about yesterday or Friday, but a new one to give people hopefully more perspective. Number two, we are going to look at the VIX, S&P 500, and then individual stocks, three specifically that I think are going to give us a little bit of perspective. So let me quickly talk about the broad picture as it stands. And I'm planning on doing this very specific sort of warning message here every morning now for as long as as it still remains relevant, of course. I'm very, very concerned for most retail investors, particularly the ones that are on the retiree front. We see how they're positioned, their portfolios are. We see their lack of concern, but also we see how much they're basically relying on S&P 500 growing their portfolio between 10 and 20% a year. As you guys know, I can't give advice here, and that's not the point. This is educational. But if you're in that boat, and it's going to take some serious hard looking in the mirror and being honest with yourself if that's what you're betting on. If you are, again, can't give you advice here, I would seriously consider the following scenario and what you would do in that scenario. What if the S&P 500 just doesn't go up anymore for a while? And even if it does, let's say 5% per year. Can you live with that? I know most people right now, initial gut reaction, oh yeah, that's fine. But truly, you're probably not in that boat, right? And again, we have a tremendous amount of insight here at the Study Trader, and I see what people do, not what they say, but what they actually do. And it's very different from what they say, and it's very different from how they're verbally kind of expressing themselves about the market. And I've been flirting with the idea of making some like crazy warning message YouTube videos, and I might still do that. And because I really truly think there's a huge risk for individuals, not because I think the S&P is going to crash, but because I think people cannot even stand the thought of the S&P going sideways or forget sideways, up 5% for the next 5 years. For most people, that's an unacceptable solution. And on top of that, forget the S&P. What if the Max 7s just go sideways, right? And that's a possibility, right? Not because they're bad companies, they're good companies, I think for the most part, but because they're crowded trades. And that can have can cause a serious problem in a lot of people's longer term portfolios, okay? So look at the S&P as it is right now. What if we, maybe go back up to 6,000, but we just stagnate? So right now, year to date, we have the S&P at essentially down 4.5%. Okay, Nvidia is down 20, has done zero zilch, zero nothing since May of last year. A lot of people sent us hate mail on that. We're saying that's never going to happen. Here we are, and so I just want people to be aware that this is the reality, and basically everything else but those Max 7 stocks are doing very well this year, right? Now, again, there's a difference between the company's fundamentals, and the insane amount of crowding that's gone into those companies. Now there's a new challenger out there, right? Nvidia, Tesla, listen, these companies have great technology. I don't doubt that. I think Nvidia can go back up again at some point. Does it have to V-shape reversal and go back to fresh all-time highs? No, it doesn't have to. Not at all. Like, it really doesn't have to do that, right? Let's just quickly go through Tesla, and then I'm going to get to the dollar chart, the big chart that I think is going to be put in perspective. So you look at Tesla, for example, and for those of you guys that have the TST Trender, and I really hope you're using it. If you have it, if you don't have it, please get it. Tesla's now back to where it was basically as far back as like 2021, right? So it hasn't done anything since 2021. It's had big rallies, but it's back to where it was in 2021. In fact, it's probably where it was in 2020. So for all the people that don't think this stock can just go sideways, or that Microsoft or Nvidia can go sideways, just look at Tesla. And I know I'm comparing a little bit of apples to oranges. Each of these companies are different. But if that is going to happen, if Microsoft and Nvidia go sideways, trust me, the S&P will not rally much. It's mathematically nearly impossible, right? It can go up, but it's not going to go up 20%. It might go up 5%. And again, for most people, that's unsustainable. Now, what about some more specifics here? Okay, so first of all, just quickly want to just point out Tesla as far as the TST Trender, our momentum indicator, goes. We received the buy signal in October, then the stock went up 90%, then we had the final stop loss at 50% gain. That's pretty good when your stop loss is at a 50% gain. And then we had a new valid short that basically became valid on February 6th. The stock's now down about 40%. Stock might be getting a bit oversold, and more importantly, it's coming back into this area. But I think, from a long-term perspective, I want to wait a bit more before I buy the stock, because it's going to take some time for people to kind of reset their expectations on the stock, and technically we're kind of right back to in the meat of where the stock was trading for the past couple of years, right? Again, like I said before, Tesla is now at the same level it was in December 2020. It hasn't gone anywhere, right? So for all the people that talk about robo-taxis and all these things, and that's great stuff, and that might all happen, that's wonderful. There's a storytelling exercise, thanks to social media, and then there's the reality, right? Markets don't work linearly, and the S&P 500 skyhooking higher at a 15% clip with no volatility for 15 years is not normal. That's linear. It's not normal, and if that goes sideways, a lot of people are going to have a lot of problems, right? So hopefully this is helpful. Steve says, thank you for the alerts. Market was down big yesterday, and my portfolio was up 1%. You're welcome, Stephen. I guess the question is, was that your trading account or was that your overall portfolio? There's a big difference there, right? What I'm talking about here right now is the overall portfolio, the net worth. Most people spend almost no time on that and only focus on the trading account, which is why ultimately they have huge drawdowns, which is what I'm trying to allude to. Okay, let's look at the important chart that I promised I would show you. This is a new chart. This is not the chart that I showed the past couple of days, but this is the history of the dollar cycles. This comes from Tavi Kosa, just to give him credit on Twitter. So just so you guys know where this is coming from. What we're looking at here is three major peaks in the dollar, and essentially these dollar. This is a different way of looking at the dollar than what I showed you the other day. But what we're looking at here is three major inflection points, right? We had the Plaza Accord, which if you don't know what that is, go ask ChatGPT quickly what that is. That was a major inflection point for the dollar. Then the tech bubble, and then what may be the tech bubble 2.0. Again, notice these are not my words, right? This is the author of this. You can look at the bottom left. But I think you need to keep in mind what U.S. equities did on the back of that, right? U.S. equities went on a prolonged sort of buyer's strike. I'm not calling for market crashes, right? But you have to understand this is not about, like, this is bigger than your 50-day moving average. This is bigger than some guy on CNBC that comes out every day when the S&P's up or down 1%, and he never has anything bad to say because he's a perma-bull. There's a lot of those guys out there. I'm referring to one or two people here specifically. You know what I'm saying here, right? So essentially what it means is that all you have to think about this, and Atul is asking a good question. The way to think about this in very simple terms, and we can get very, very complex on this. What is this telling us, right? In very simple terms, all the money, all the liquid investable capital has been sucked into U.S. markets over the past 10 to 15 years. You can look at that by looking at the crowding of positioning in Microsoft, Apple, Google, NVIDIA, you name it, right? We always talk about this pretty much every day here. If let's say you're a foreign investor, like a central bank or a family office or whatever, and you're buying those stocks, you have to buy dollars. So the dollar price goes up, right? But when there's an alternative to invest in, which now there is globally, Europe, Latin America, Asia, right? China specifically in our view, all of a sudden you have to ask yourself, why am I paying huge multiples to own a stock that's already run up like crazy? That might be a good company when I can buy a 9 times earnings multiple story somewhere else, right? And that's when the dollar begins to deflate. And so I keep saying this is about positioning. So this is not about your trading account, and thanks for clarifying, Stephen. That's really my point. This is not about your trading account. This is about your net worth. Again, I'm not giving advice here. This is educational. But most people only focus on the trading account, whereas their net worth over there in an IRA or somewhere, they're hardly looking at. But that's the majority of your money. If that stops growing for 5 or 10 years because you're in Max 7 stocks or you're in the S&P 500, that's a much bigger problem for most people than if their trading account doesn't do much, right? We live in a gigantic gambling bubble, folks. Like, it's enormous, and people have completely lost sight of the long-term money that they own, which is the majority of their assets, versus the little trading account that they're dicking around with, right? And I don't mean this in a derogatory way. Certainly probably came across that, but that's not my point. I just see how people are completely blindfolded by shiny objects, right? So you've got to start focusing on the big picture. We do trades all the time, and I'm going to look at a couple of trades for you guys right now. But this is so important to not lose sight of the big picture, right? Because it does you no good if you lose 50% of your net worth, but your trading account is up 10%, this year. That's useless, or over the next 2 years. It just doesn't help. So keep this chart in mind, study it. Please take this tough steers. This is no longer we believe is no longer S&P's down 10%. I'm just going to buy it with both hands because guess what? I'm going to go play a round of golf and it's going to be back up at all-time highs. It can happen, but it's much less likely to happen now than it was before because there's a lot more alternatives to invest in right now. Okay? So that's that. Now, the other thing we have to keep in mind, the S&P is at a pretty critical level. We do have, so this is now I'm switching back to the trading stuff. Okay? So all of you guys who didn't care about that before, you can start listening again now. So this is the S&P 500 in terms of the simple price chart, and we've broken out of that boring range we were in. Obviously, we've accelerated a downside, but we're coming back to a level that has a lot of memory, that it served as a lot of resistance last summer, all the way through August, and finally we had a breakout in September that lasted until basically February, and then of course now we're down. It took us, just to give you some perspective, it took us September, so October, November, December, January, February. It took us, just to give you some perspective, it took us 5 months, okay? This is what I keep talking about. This is why people, it took us 5 months to climb from the breakout to here, okay? This is what I'm trying to say. This is 5 months right there. This error is 5 months worth of price action. Okay? And it took us 3 weeks to do this. Okay? So 5 months versus let's say 3 weeks. This is the problem, right? And I can't express how important it is to understand. Now the question, of course, is what now? I do think that it's possible we get a near-term bounce. Maybe we go to lower highs. Again, the situation is very fluid, but we are getting a lot of oversold signals, I have to say. So I would like to take you through a couple of them that are starting to look pretty interesting. And then we're going to meet over at the Inner Circle at the Market Rover member session in about 3 or 4 minutes. So first of all, let's look at the banks. You look at something like JP Morgan, okay? Now, JP Morgan hasn't yet entirely filled its post-election gap, but it's getting closer. And so I'd like to share with you quickly what some of the other banks look as well. And it's also coming into its 200-day moving average. So it doesn't mean there's no downside left. It just means that there's we're coming into much better levels. Again, JP Morgan took, a whole bunch of months to go up. It took a few weeks to erase that entire gain. This is what I'm talking about. You look at Citigroup, very interesting as well. Citigroup is now back at an area with a lot of memory. Again, it hasn't entirely filled its post-earnings gap, but it's at the 200-day moving average well. So these are the kind of things that we like to look at. And then the last one really quickly is Delta Airlines. The airline's obviously struggling. They had earnings last night from Delta. They're talking about the weaker spending patterns on domestic flying, which makes a lot of sense. I would watch this one very closely. I'm going to watch this very closely. We're going to talk about it in the chat room and watch it very closely today. And then also want to quickly talk about, just quickly going back to Tesla. Again, it's entirely possible we see an oversold bounce here from a pure trading perspective. But again, we need some sort of confirmation. And the trender and the vertical explorer are going to give us signals on that. And we'll talk about that and narrate it throughout the trading sessions here in the trade ops chat rooms. So that's what we're going to do here this week, and hopefully this is helpful. We'll see you guys back here tomorrow at 9 o'clock Eastern. Please make sure you join us over in the Market Rover session starting in about 2 minutes. We'll see you guys over there. If you're an ETF Silo member, we'll see you at the top of the hour. So that's 10 o'clock Eastern. And then we have a special, I'm gonna go live again an hour later at 11 o'clock Eastern today. It's open for everyone. We're going to talk about sector rotation and a lot more. So a lot of stuff going on this morning, and look forward to seeing you guys in these things. Please give us a thumbs up, please subscribe to the channel. Very important so that you stay up to date when we go live. And we will see you guys on the inside here in just a couple minutes.